Hello, everyone. I'm Michael Glass from LearnTheTruthAboutMoney.com, and today we're going to share another one of our stock market tutorials where we're going to focus in on how to use Camarilla Pivots. Before we begin, we always like to start off with our disclosures. Before you begin investing, you need to consider all the important aspects of investing. What are your objectives? What are the risks of investing? What are the charging expenses involved? What are you trading stocks, options, futures, forex? There is a potential for substantial risk of loss. You can lose your money. You can lose all of your money. As we evaluate strategies like today, as we talk about Camarilla Pivots, we're going to use historical data. We're going to use symbols. Future results are not guaranteed, and more importantly, by using certain symbols, we are not inferring any recommendations. And finally, most importantly, any investment decision is solely your own responsibility. Trade at your own risk. So you guys know my philosophy is all about understanding our job as traders. It's how I present and it's how I trade. Our job is to recognize opportunities in the market and then apply the right strategies. Our job is not to trade. Our job is not to get in and out of trades. Our job is to recognize opportunities and then apply the right strategies. Just like in baseball, and you guys know I love my baseball analogies, my real estate analogies, and I'm all about analogies. But in baseball, as you're a batter and you see a pitch, your job is to recognize the opportunity and then apply the right strategy. Are you going to swing with it and pull it? Are you going to hit it to the opposite field? Based upon the pitch, based upon the opportunity, you're supposed to swing at the ball accordingly. Same thing in the market. Based upon the time of the day, based upon the momentum of the day, based upon the type of the day, all of these things funnel into the opportunity, and they also help us filter out different trading setups so that we can focus on the right strategies. So one of the ways I believe professional traders have that discernment to find the right strategies as they see opportunities present themselves is understanding value. Certainly we all have gone to fast food and we all are very familiar with the term value meal. And Warren Buffett has this great quote where he says, price is what you pay, but value is what you get. And as I go to another analogy, and we go to real estate, and I learned as a realtor very soon in the market that you make your money when you buy. If you buy a property at a good price, it gives you the flexibility that you need to get out of that property down the road, whether you're buying a house for yourself or if you're flipping a house. If you buy at a good price, you can gives you that flexibility. You don't have to get top dollar to get out. You can move around. If we go think about a football field, if you get the ball at the 20 and move it all the way down to the other 20, that's great as a trading setup. However, if you don't get in until the 40, you've lost some room, some flexibility there of where you get out. So that's why we don't chase. That's why we get over our fears about missing out. We have to get in at good prices. And the way that we define those good prices, and the way professionals define those good prices, is under a simple concept of support and resistance. That's trading 101 right there. That should be the foundation for any trading setup that you are working on. You have to understand what the market is doing. You have to understand location, as in real estate, and you have to understand support and resistance. Now, there's multiple ways that traders identify support and resistance. There's trend lines, moving averages. In the picture before, we had our horizontal support and resistance lines. Some people use chart patterns. And as we talk about today, some people use pivots to help identify value. Now, pivots basically are a average of the high, low, and closing price from the previous day. Many traders use them to determine the overall trend in the market. If you're above a certain pivot, it's a bullish day. If you're below a certain pivot, it is a bearish day. Now, there are various types of pivots. There's woody pivots, there's person pivots, there's traditional pivots, there's all kinds of pivots, and there's all these funky ways to calculate them. But what's most important for you to understand is most charting platform, no matter what type of pivots you're using, will automatically calculate you for them. So I'm not going to spend a lot of time talking about how to calculate it. But it is important for you to know that there are Woody's pivots and person pivots, Camarilla pivots. And I'm sure if you Google pivots, you'll find all different types of pivots. And they all have their place. As you guys know, I'm the type of person who believes all these setups that you can Google and find are fine, and they all work. The question is, do they work for you? And more importantly, are they the right strategy for today's opportunity? You always have to test with today's market environment and find out what's working now, because what's working now may not work next week, next month, next year. So today we're focusing on Camarilla Pivots, and what exactly are they? Well, they were created in the 80s by Nick Scott, and they work basically like normal pivot points. They help you trade those breakouts. They help you identify the trend, bullish and bearish trends. The difference is there's a lot more of them. When you think about pivots, you think about support 1, support 2, support 3, resistance 1, resistance 2, resistance 3. Well, here there's actually going to be 8. But what really makes them different from other pivots is they're focusing on the mean. If you think about the college and high school, you think about those bell curves and how you hated that person that was getting 100 because they threw off the curve. And that's sort of what the Camarilla Pivots are based on. They're based upon the concept that as we make these moves in the market's going to want to come back to the mean and come back to the average. And so they help you identify places where, okay, this is where we're going to be bullish and bearish, and this is where we think the market's going to come back to the mean. So they split all of these lines, these pivots, into, as you can see, 8 different levels. And there's 1 through 4, and then there's H3, H4, and L3 and L4. And the way we look at it is there's a certain range where we're splitting. The first split is where we're staying out of the trades, and this most important levels there, the H3, H4, L3, L4, are where we're identifying our reversals back to the mean and for our breakout levels. So I can't think of a better way to explain all of that than by taking a closer look. So as we look at our chart, there's a couple things that we need to identify. First of all, we have our L1 through L4 zones, and those are our purple dashed lines. That is our L1, and remember, our rules are while the market is in this zone, we do not initiate a trade. Come over here, see the same thing. I do have a 5-minute chart on right now. So in this L1 through L4 zone, we do not initiate a trade. Where we're looking for trades are in the H3, H4, L3, L4. How do we identify that? Well, let's take H as higher and L as lower. So here's our H3. It's our first red dashed line. That's how I like to denote it. You can set up your charting platform however, but I like to denote H3 as red because the rules are the H3 is a reversal back to the mean. Of course, in our example here, we really didn't get that. And that's why I said, even though the technical rules are as soon as you hit H3, you enter a trade for a reverse, which your stop at H4. We really didn't get that, and that's why I said we should look for confirmation. So we never really got confirmation that we were headed back. Never got confirmation we were heading back. But I have it as a red line to denote, sell. Have this as a green line for what? To denote buy. Well, what do we say? H4, we're looking for trades in the direction of the trend, trade to the upside. You can trade now this way. I think you can trade it both ways. You can trade the breakout. We do get the breakout here. Got a nice little 1445 up to about 1450. Got a nice little 5-point move. Even if you wait for confirmation, we get our confirmation in here and we get basically the same type of move. So H3, we're looking for a reversal down back towards the mean. Hopefully even all the way back down to L3. Think of L as lower. H4, we're looking for a breakout to the upside. I chose these days because we kind of have a little bit of both. Now here, on this day here, I'm now down in L3. I denote that with a green for buying and L4 for red for selling. And again, here is where you're supposed to take the trade. What's a stop here? I wouldn't have because, again, we didn't really get confirmation. But we did, as we come back through, we broke it. And as we came right back through L3, now we do have a little confirmation and you would have had a nice move here. This is 1540.25 and it goes all the way up to 1546.75. So a good 5-6 point move in there. Even though we didn't get all the way up here, a great move here. And again, we got that confirmation. Same thing here. We broke down through it, and now as we came back up through it, still had a nice little 4-point move here. Even though we didn't make it all the way up here, Now on the bottom, if you were to trade it as a breakout, the bottom here is 1534.60, which would be 75, and it goes all the way down to 1530.75. That's 4 points. So I don't want to be biased, so let's just pull up a stock. I've got ES up there right now. Let's go look at, let's say, Apple. And I just want to make sure I have, let's see, there we go. At least over here now we have our L3 and L4. Again, we're not initiating a trade while we're in the middle. You really, I could go into my setup studies here. A friend of mine modified just to show all these other pivots, and I could go in here and say don't show L1, to have a nice cleaner chart. And apply, and all those purple lines are gone, so it's a little bit cleaner to see. And again, we hit H3, wait for confirmation. We really get confirmation here, coming back down through, and we tested it, so we got confirmation right around here of a break, and we do get a nice move, even 395 down to almost 390, almost a 5-point move there. If you traded this as a breakdown, pullback, and however you want to define what you consider confirmation to trend back down, very, very nice indeed. On this side, pretty much the same thing. What I do want to say, and again, is a couple things. Like I said, mine's modified not only to show L1 through L4 and H3, H4, L3, L4, but to show all of these. And here's why that's important. If you'll notice, again, what are we talking about? Why are we using pivots? Value, support, and resistance. And you'll see, look at this. I mean, this is really interacting with these lines very well. If I go back, I know I just took them off, but let's go back and put them back on. You'll see that the market really does interact with these lines. And so again, looking for value, looking for places where people might be looking for places to get in and out of trades. These lines, you could almost say Camarilla Pivots are very similar to fibs. And again, you can see, look at the market come right down, interact, come right up, came here, interacted, came down. Where did it stop? Right there. Same thing here. Came, stopped, messed around with this line, came down, paused at this line. And that's another reason why I like these Camarilla Pivots, because they give places where the market seems to be going to as far as potential support and resistance levels, value, and again, places to get in and out of trades. Let's pull out a Forex just to give you one more comparison. And again, got a little move here where we get a little confirmation down. We got a little breakout going on up here. But what I really want you to see again is look how the market really is interacting with these lines, and why I like to have on my charts, if for nothing else, just to show potential places where the market may change direction, may take a breather. It really does do well. So to review, our trading rules for Camarilla Pivots is to identify the H3 and L3 levels. When price breaks through those levels, we want to take a trade in the reversal level. Now again, smart traders are going to look for confirmation, not just going to blindly say because we went through a level, I'm entering a trade. We always want to confirm our trade. So if it's a reversal, we want to confirm that it's a reversal. Although the true authentic rules are, as soon as we hit H3, you place a reversal trade. H4 and L4 are our breakout levels. We want to go with the trend when price breaks through these levels. Now here you can be either way. You can be the traditional breakout trader that trades the break initially, or you can be, again, look for that confirmation, look for that breakout, pull back, and then, again, push in the direction of the trend. Just like market profile, when we're in between H3 and L3, we consider that noise, and we're not going to see any real definitive direction of what the market is trying to do. So the question I have for you when as we started off our video is understanding values. Professional traders are able to apply the right strategies because they understand value. And so, do you want to be a wholesale trader or a retail trader? Do you want to be the person getting in the trade at a good price, which allows you the flexibility to exit a trade, or you want to be that retail trader who's getting shook out of a trade because they got in at the wrong space, they get stopped out of their trade, and then the trade market does what they thought it was going to do initially? I mean, we've all been there, and typically it's because you went long at resistance and you went short at support. And so the wholesale trader gets in, gets its first target, second target, and they get out of the trade. So because the professionals are getting out of the trade, the momentum is ending when you, the retail trader, getting in at retail prices, are getting in. And so because the momentum goes out, price comes back, you get stopped out, and then there may be value again. The professionals get back in and push it and do exactly what you thought it was going to do afterward. So it's very important, again, when you're thinking about your trading, is making sure that you're able to identify value. And that will help you filter out as we, again, find opportunities in the market and we apply the right strategy. So hopefully you enjoyed another one of our tutorial videos. At learningtruthAboutMoney.com, we're focusing on financial literacy and helping people raise their financial literacy. In today's economy, we sure all can use a little extra money, and we believe the best way to get passive income is through the investing in the stock market, and we have plenty trainings and tutorials to help you do just that. Thanks, guys, and I'll see you next time.